Hey, everybody. Thanks for joining tonight on our income, debt, and growth fund webinar that we're going to talk about, which make up the Spartan storage funds that we have available to investors. We'd like to remind everybody as you join, if you have any questions, you can put questions to investors at spartan-investors.com. That's our email address, and we'll get your questions answered right away. And you can also schedule a call with us. So if you have any questions throughout the course of the evening, this QR code will put you on our link to one of our teammates that can walk you through any questions that you have. You can schedule a call. You can talk about the investing, things like that. Alternatively, you can email investors at spartan-investors.com. We can also handle your questions via email that way. So that QR code will get you on our calendar to talk about investing. So what we're talking about tonight is mostly just about the income and growth fund. We are going to touch a little bit on the debt fund, but the debt fund has pretty much fully filled up already. So there really isn't anything available in the debt fund tonight. So we're really going to talk about the income and growth fund, which are equity deals where you get ownership interests in the both funds that go out and buy these self-storage assets. And we're going to talk about that. But if you go to our website, you can also get more information, videos, replays of webinars, things like that. And we can talk about that in our deal room as well, as we'll get into right now. So if you're a Spartan investor already, you'll know that we have our website, spartan-investors.com. You can click on the investor portal up there in the top right, and that brings you to this login screen. And you can either create an account or you can log in and just return to where you are. And then this takes you to the open offerings page. You can see here, if you click on open offerings, you can get the debt, income, and growth fund opportunities. And this brings you into the deal room. So everything I talk about tonight, when I say our feasibility study, our underwriting file, our wiring instructions, our operating agreement, our PPM, all that information is inside the deal room, and you can find it right over here to the right for each respective fund. And then you can get started on the investment by clicking on the Invest Now button, and then that will take you through 4 very quick steps, and then you can sign documents and subscribe to the offering, and then send in funds. So again, for those that just joined a little bit later, you can QR code the QR code on the screen. You can scan that, and that'll drop you right onto a landing page to book a call with us if you want to talk through any investing. Alternatively, go to investors at spartan-investors.com. So we're going to go ahead and jump into the offering tonight. We're not offering any tax, legal, or investment advice. Please do your own due diligence on the offering. Consult your tax and legal team. And this is just a general overview. So these are all just projections, forecasts, best guesses at what we're going to accomplish in the funds. And so for complete due diligence, again, please consult the deal room and your financial advisor or your tax team. So why we love self-storage is because of how recession resistant it's been over the last 30 plus years. Specifically, self-storage has been the best performing asset class out of all other major asset class types over the last 28 years. And you know this, I love starting with this chart because it shows the Black Monday events of 1987 where markets cratered over 30%, the dot-com bust of 2000, the Great Recession of 2008, and COVID pandemic where GDP just absolutely just tanked when the onset of COVID-19 came on. And you can see here, I mean, self-storage occupancy just completely maintained its darling asset class status and really performed well no matter what was going on in the economy. And that was really because self-storage is dependent on life events. So when you think about why people use self-storage, you may be thinking, I used a self-storage once, and it's because people downsize, they relocate, their jobs change, they have to free up space in their house to make room for a gym or an office, because work from home is becoming more popular. And people are constantly on the move. And that's why self-storage does well during bad times. So if you think we're going to go into a recession, if you think things are getting worse, this is an asset class that you want to be in as a hedge against a declining economy. And likewise, when the economy is doing well, we also benefit. So it's a completely uncorrelated asset class to the rest of the market. So it's really nice. You can see during COVID-19, self-storage was the top performing REIT. Actually, it was the top performing asset class among all major asset class types in the last 2 downturns. And so COVID-19 was no different from that. And, I love to point this one out. People think, oh, self-storage, people aren't using it as much or whatever. But actually, self-storage utilization per household has actually increased over the past decade or so, up to 11.113% utilization per household in the United States. So this is a pretty telling demographic as we kind of get into the space. And who uses self-storage? Well, mostly Gen X and millennials. You can see 34% of our customers are millennials, 34% are Gen X, a kind of equal capacity there for between Gen X and millennials. And that's because these are the generations that are having the most life events right now. Millennials are starting to have children and grow families and change jobs and buy homes and things like that. And you can see that the generation that maybe it's not having so many life events like Gen Z, like the younger generation, maybe they're just getting started, they're still in college, they're our lowest client. And so you can see that self-storage truly is just a life event play. And so it's been no secret that, these institutional shops are coming in and buying up self-storage. You can see just in the last couple of years, Public Storage has bought over $3 billion. Blackstone got into the game, bought a $1.2 million purchase of Simply Self-Storage to get into the brand. Bill Gates got into self-storage, bought a quarter share of StoreMart. Inland Private Capital monetized a huge portfolio, $265 million deal. Simply went on to buy another 10,000 units, and it just goes on and on and on. And Spartan really took advantage of this. We got into the space and started to build a really nice portfolio up. We built our portfolio up now to about $600 million. In 2021 alone, we bought well over $200 million in assets to really build up our storage. And more consolidation in the industry is happening. You probably saw maybe the recent news of Life Storage being acquired by Extra Space for a record $12.7 billion deal. That's the largest transaction that's ever happened in the self-storage space. And you may be thinking, like, what's the so what here? Well, consolidation of assets, market share. These companies are trying to come in and find and buy market share, and there's just not that many self-storages to buy. And so people are really bidding up this product. We're seeing some of our properties that we're selling now trade as low as 3 and 4% cap rate, even on lower quality assets in tertiary markets. So the companies really want to be in this space. And the Extra Space deal really tells the tale of the acquisitions in that they needed market share. And the only way to grow was to buy another massive REIT, Life Storage. And this was bid up. Public Storage took the first offer on it for like $11 billion or so. And then Extra Space came in and did the deal at 12.7. So highly sought after space. And then there's also been huge self-storage funds put together. Specifically, the largest self-storage fund to go and buy these things was put together just in January of this year, amid the recession, amid rising interest rate environment, amid the inflationary environment. They put together about $2.5 billion. And this was sovereign funds, pension endowments, every kind of fund is trying to get into the space. And so what we like is our positioning, right? So what does it matter? What does it matter to the investors, and why does that play favorably into what Spartan's doing? Well, if you look to the right side of the screen, these are all those companies that I mentioned that are out there hunting for this stuff, buying up other big portfolios and operators. And so that's kind of where we fit in. So we go out and a Spartan in the middle kind of is that medium-sized fish that goes out and buys up all the little mom and pops. We assemble a pretty big portfolio. And then one of our many takeout strategies is to get bought up by one of the bigger fish that want portfolio consolidation. Extra Space doesn't want to go out and buy, 100 $3 million properties. They'd rather buy a portfolio of properties that have been assembled and well managed by Spartan. And so that's a great exit strategy, and really tells the tale of how we're going to exit these assets and why investing in an operator like Spartan is beneficial, because we can get a better premium on a portfolio sale. So this is kind of where all of our properties are today. And you can see we have quite a bit in the Sun Belt region and in Texas. And then we kind of have a smattering throughout Colorado, Wisconsin, and the Pacific Northwest. And we're looking to continue to grow what we buy in these funds that we're going to talk about in these markets where we already have economies of scale with our existing portfolio, making it more attractive and more valuable to a bigger buyer. So how big is Spartan? Well, we're the 40th largest operator of self-storage in the United States. So I mentioned those other operators that want to buy us. Some of them are pretty sizably larger than us, but we're still kind of right there in the mix in the top 50 operators. And the way we built our platform and built our team is through our leadership team. So Scott Lewis and myself started the company, and Ben Lapidus also joined as a partner. And the three of us make up the executive leadership team. And we've also been joined by our president of our construction company, Aaron Saunders, Matthias Kelmer, Whitney Ham, and then Kevin Holst, our chief legal officer. And we'll kind of get into each of the leadership teams here in just a minute. So, and we built a vertically integrated company to do all aspects of self-storage. So we don't just buy them. We buy them, we find the debt for them, we syndicate, we do all the construction, asset management, and the property management. So there really isn't anything in the investment process that we're not doing. And we think that's a great mitigation of risk strategy by being able to do all of these things. So this is our free up storage team. So if you walk into one of our self-storage facilities, we brand it as free up storage, and our team runs it. So we have, I don't know, maybe 50 or 60 employees that manage the entirety, but these are our corporate staff here for free up storage. And it's our president, Matthias Kelmer, comes from Extra Space, where he was actually the vice president of asset management there. So we recruited Matthias to really take our brand to the next level. And then when we have improvements to make and we have construction and new ground up developments, Aaron Saunders, our president of Spartan Construction Management, handles all that. So this is all an in-house team, and we have everybody from the person at corporate who's planning the project and overseeing the timelines and development and coordination, all the way down to the person in the job shack trailer is going to be a Spartan. So we're fully vertically integrated. Our contractors are licensed in multiple states, and so we directly oversee the construction. And what we do before we buy these properties is we put them through a rigorous 700 plus due diligence checklist. So we have a due diligence team inside Spartan who goes through all of these things: site inspection, zoning, environmental, financial, everything that goes into doing due diligence on a process, on a property. And we share this due diligence checklist in the deal room with our investors, and we show you how we've done our due diligence on every single property that we buy. So it's really important that the due diligence process is well defined. So this is just kind of a look in some of our stores. This is from top left, that's in Georgia, middle one's in Seattle, the one on the right's in Portland, just outside of Portland, Oregon, and then the bottom two, one in Wisconsin, one in Florida. These are just kind of some of what our stores look like. We brand them in our free up storage national brand. So when you walk in, it's clean, it's well branded, it has a good store manager to brand standards, and a great retail offering, cameras obviously in display for the customers. We give a really great retail experience to our customers to make them want to book with us. But we're going to go ahead and just get into it. So the mechanism that we go out and buy these properties in is through our funds. And so we like to give investors the power of self-storage, but offer them different modalities in how they invest. And the reason why we do this is because we find a lot of really good opportunities. We look at thousands of deals every year and pick the best ones. And sometimes deals have a little bit more hair on them, or they're ground up development, or they're a lease up play, and they have a bigger upside potential. And also they may be a little bit more opportunistic in nature, like their ground up development. And so we categorize which properties go in one of our funds based on their risk profile and their upside potential. So if you're interested in the most upside opportunistic types of deals, the Spartan Storage Growth Fund is just that. And I'll give you an example of a property here that would go into the growth fund. This is a ground up development that we built in Sandy, Oregon. And this is how we bought the property. And then what we did was we built this beautiful Class A facility. And so about 355 units or so. And you can see we really did a nice job of putting architectural design features into this, branding it really well. And then what we do is we take it through its lease up. So that we staff the facility with our free up storage team, and then we lease up the units. The other thing that the growth fund might do is we might acquire a property that exists and produces some cash flow like this one, and then add on to it. So what we did here is we took this 2 acres of vacant land, and we actually added on about 40,000 square feet, or about 240 units. And so that's another part of the process. And this is our team out there, our Spartan construction team that would go out there and build the units. We would do a lot of marketing and branding of the property, and then we would start the lease up phase. And again, a lease up those additional units, and that's where a lot of value would happen. This is the last example that I have, which is a very challenging entitlement process that we went through to build this property, this brand new Class A facility just outside of Seattle. And then again, we put the free up team in place, and then we go ahead and lease up the property to stabilization before we sell. And I think what you'll like the most about the ground up or the growth fund opportunities is there's actually some really great returns that you can hit, but also optionality, which I'll get into. So we're targeting between 19 to 26% annual returns in the growth fund for our investors. And we roll that up to about a 1.95 to 2.3x multiple, meaning that we project that you'll basically a little over double your money in 5 years. So all these are on a 5-year hold time period and 15 to 20% IRR. So these are the target returns for the growth fund. But the optionality in the growth fund, I think, is my favorite part. So I mentioned we buy this land, then we develop it, then we open the property, and then we sell it or we lease it up. These 3 options really provide a lot of risk mitigation strategies. So in the first year, this is just an example of a property that we could buy, and we could just do all of the horizontal, meaning that we get all the plans, all the permits, all the approvals. Maybe we have to rezone the property, whatever. And then once we actually buy the property, it's completely entitled. And so we could sell the raw land without even putting a shovel in the ground to another investor group and make a great 25% project level return, which the investors would benefit 20.9%. That's one option. The other option is we could build the property and get it to what's called certificate of occupancy, sort of be like a merchant builder. And then we could sell it at grand opening for a great profit and not have it go through the lease up risk. And so that would be about 146% project level return, or about 109% going to the investors in 2 to 3 years. Really nice return. Or we put our free up team in place and get it stabilized, like we talked about earlier, where we just take the free up staff, we put it in, and we lease up the property. And that's obviously going to produce the most returns, but over a 4 to 6 year period. And so that would be about 150% return to investors. So really great optionality when you're in the growth fund. And so how we split up our profits is by how much you invest. So if you invest under $1 million, so 50,000 is our minimum, up to $1 million, you're going to get the first 12% from the sale. That's what liquidity preference means. It means when we sell the property, we have to give you 100% of what we make until you hit a 12% annual return. So if it took a year to do something, you get $12,000 before we take any splits. After that split, you get 60% of the deal, 60% of what's left over, and then we only get paid 40%. Now, if you invest more, you get more. So $1 million to $3 million, you get the 14%, 65-35 split, and then obviously you invest over $3 million, you get 16% preference, and then a 70-30 split. So very favorable splits to our investors. So this is what we look for. We look for great demographics. When we look for a property, we're looking for strong job growth, net positive migration. Usually we're looking for 1 to 2% population growth. And then we want to find unmet storage demand in the market. And we want to look for markets that have rent growth opportunities, income growth opportunities. And then we like to build these around the other properties that we own, because we find that REITs want to come in and buy $30 to $100 million of assets minimally at a time. So if we have a nice little portfolio in a given market, that increases our buyer pool. We can also sell them off individually. So these are kind of the things that we look for. And every property that we buy, we do a full feasibility study. So you can go to our deal room right now and look at all the feasibility studies for the properties that we have under contract in the growth fund. So where do we build these? This is actually a property in the growth fund right now. It has strong drive-by traffic. So specifically, this property has 28,500 cars that drive by every day. And what's really neat is if you look at the 2 yellow parcels, that's what we're buying. There's 600 linear feet of visibility from this road. This road is a very busy road, and we have a very wide presence on the road, which is going to increase our advertising and our visibility. So we like that. And we also like the fact that it has easy access. So I would rank this site a 5 out of 5 from the standpoint of there's a lot of traffic, it's got great visibility, and an ease of access. So this is the type of property that we look for when we're constructing new facilities. So what's in our pipeline? What do we have now? Well, property you just saw is in Bellevue, Florida, which is about an hour and 15 minutes north of Orlando. It's in a market where we have 1.47% population growth projected over the next 5 years. It's in a market where we have $18 storage rents, so high rents, and there's over 1,500 homes being built within a 10-minute drive time. That's the kind of projects that we look for. And we've been under contract with that property since October of last year, rezoning the property, entitling the property, and we don't close on these assets until we've eliminated the entitlement risk. So when we close on this property, we're going to start constructing it right away. And so we're planning on closing on this asset in the summertime. The other property we have in the pipeline is in Pea Ridge, Arkansas, which is about 10 minutes from Bentonville, Arkansas, which if you're not familiar with Northwest Arkansas, this is it's the number one mountain biking area in the United States or in North America. And it's also home to three Fortune 500 companies, J.B. Hunt, Tyson Food, and Walmart. So the population growth there has been astounding. So we plan to buy this existing property for the growth fund and add on 27,000 square feet of expansion. And we've had a lot of success in that market to date. And then a property that we just put under contract is in Kingsland, Georgia, which is about an hour north of Jacksonville, Florida, which is a booming town. That whole area of South Georgia, North Florida on the coast is really on fire as far as population growth goes, jobs, and people moving to the area, which is a big driver of self-storage. So when you look at Kingsland, that property is going to be bought from a developer at C of O. And the developer, he built the property, but he wants to go spend his money on building more homes in that market. That market is absolutely exploding with population. So Kingsland, Georgia is a great market for that. And when you roll this all up, these properties are actually projecting a 26% annual return for a Class C investor. So if you're thinking, okay, well, what does this mean? Our targets are 19 to 25%. We're right in our targets, maybe a little bit ahead of our targets for the properties that we already have in the pipeline that are all planned to close over the summer time frame. So let's talk about the income fund, kind of changing gears a little bit. And if you're like, I don't want this risk, or I want something that just has a little bit more predictable cash flow, the storage income fund is where you want to go. This is going to still give you. This has better cash flow projections, and then it also has upside potential, just like the growth fund. It also comes with a little bit more predictable depreciation because we know that in the year that we buy an asset that's entered into service and cash flowing, we're going to get that depreciation. It's not to say the growth fund won't have depreciation. It just might not be as predictable of when it comes because property has to be entered into service. So the income fund is going to be a great value add existing and core plus existing asset purchase. So here's 6 examples of what we would buy in the income fund. So these are actually the Spartans. This is our fund that we did last year, Spartan Storage Fund 1. These are the assets that we bought. And so these are all just value add and core plus existing facilities that we buy and we better manage. And we look for markets that have strong population growth and economies of scale with our other properties, just some of the demographics and requirements of purchase. And so this is what we're going to buy. And the target returns on the income fund, 14 to 20%. So a little bit lower than the growth fund because there's just not as much upside in these types of assets, but still great returns, 4 to 8% cash flow projected, and a 1.7 to 2.0 equity multiplier. The investors who invested in this fund early are already getting distributions. Their first distribution is actually going to go out on June 1st. So this fund is already cash flowing, which is great. Growth fund also will have a distribution as well. So what do we buy in the income fund? Well, we buy things like this. We find value add opportunities that we buy from mom and pops, and we better position them. So obviously these are rundown properties without signage, without branding, that need repositioning. So we take it and we do things like rebrand the signage and make the curb appeal better. We get our free up storage national brands in place. We go into the offices, and these are some of the offices that we've purchased, and we rebrand them to look a lot nicer and a lot more retail-like, like we were talked about in the beginning. And we do things like security. So we better camera equip the facility. We fix fencing. We install lighting. We resurface the drive aisles, repaint. We basically make this facility look and feel great so that people they feel that their belongings are going to be safe and secure when they book with us. We also get out there in the community and get our facilities well branded and advertised. So these are just some of the community events that we've done just to be a better operator. Some of our value add strategies that we employ on both the growth and income fund assets is we do things like we sell tenant insurance. So we have a $13 and an $18 plan that we sell to our customers, and that is a way to add value. So if you buy a 500 unit facility, we can roll out our tenant insurance program, and maybe let's say 50% of those tenants take our tenant insurance plan. We can charge them all $13 to $18 a month for that insurance, and we split that 70-30 with our insurance company and profit with that. So and we share that profit with our investors. So it's a really great revenue in producing strategy in addition to collecting the storage rents. We also do things like U-Haul truck rentals, retail, and we do some benefits like sometimes we'll have cell phone towers or billboards or other ancillary revenue on the property. So it's a really great strategy. But the income fund has similar investor benefited splits where you can see investments under $1 million, give it 7% preferred rate of return, meaning you're getting it 100% of the cash until you are made whole on 7% annually or a daily accrual. And then you get a 70-30 split to a 14% hurdle, and it's split 50-50 thereafter. $1 million to $3 million gets an 8% pref, so a little bit better. 70-30 split to a 15% hurdle, so again, a better hurdle. And then a better back-end split, 55-45. And then Class C investors get the best return, $3 million investments or more, 8% pref, 70-30 split to a 16 hurdle, and a 60-40 split thereafter. So very favorable terms for the income fund as well. So how does it work? Let's say you invested today. How would it work? Well, funds are accepted into our deals on a first come, first served basis based on when funds are received. So if you commit, that's great. If you fund, you're in line to have your funds deployed 100% into all of the properties that we buy into the funds at their original cost basis. So you don't just get the benefit of one property, you get the benefit of the whole portfolio. So all the sweat equity that's already gone into repositioning these properties and branding them and operating them and getting them into a better position of highest and best value, you benefit from. And then lastly, distributions typically begin in the income fund about 90 days after your investment goes active into the fund. And so that's kind of a conclusion on the storage income fund. Again, if you have any questions about the income fund or you want to book a call, you can see on the screen here, I've got the QR code again. That'll land you right on our bookings page so you can book a call with one of our investor relations team, or alternatively, you can email us at investors@spartan-investors.com. So I wanted to touch on the debt fund. The debt fund is closed. It filled up and fully subscribed, and we're no longer accepting investments into it. But I just wanted to let you know we do have other opportunities in the debt fund, or in private debt, I should say, where this provides you monthly cash flow, monthly distributions, and it's backed by our self-storage portfolio or self-storage assets. So just get in touch with our team. The debt fund, again, is closed, but if you wanted to invest in private debt, we do have a few opportunities, kind of one-off deals that we can talk to you about as well if you're just more interested in just getting a private loan to one of our properties. And so our investors get monthly updates, monthly financials, monthly distributions, and we try to get our K-1s out in March so you can get to your tax returns quickly. And so this is just kind of an example of what you're going to get every month in our investor communications report. You get a little bit of hey, what's going on at the property? And you get pro forma versus actual reporting on a quarterly basis. And we share the P&L and any financial data that you would like on the property. And we're fully transparent in our updates. So people love our updates. They love that we're touching base every single month. And and that they can pick up the phone and call somebody at Spartan and talk to them about how their investment's doing. We have a team that's well equipped to handle that. So I just wanted to thank everybody for coming out tonight. One thing that I did want to mention, we are doing a DST fund. So if you do want to roll some 1031 money, or if you're more interested in maybe a one-off deal that's buying one property, we do have a DST fund for that. That's going to purchase a property in Texas. So I don't want to end tonight without saying that we do accept 1031 exchange funds only into that DST opportunity. The other income fund, growth fund, debt fund obviously can't take those 1031 money. We don't do that. But if you have any questions, again, I put the booking link on the screen there, the QR code. You can also just email us and let us know. We can get a time scheduled to call. And I just wanted to thank everybody for considering Spartan, coming out tonight and watching the webinar. Thank you, and have a great rest of the evening. Thanks, everybody.